Well, thank you for the very kind introduction. Always a delight to be participating with CanCham, and great turnout today. Really appreciate everyone staying for after lunch. I know that's a high ask, so delighted to be here today. As I was introduced, I'm Todd Pappo. I'm a managing director with Northleaf Capital Partners in Toronto. We're a global private markets investment firm. I think the topic today we'll be speaking to is certainly quite timely, but it's also important in the context as we've seen with the interaction between many investors we know in Hong Kong and certainly the opportunity in Canada, which has been thriving over the last 10 years, in particular as it relates to venture capital and growth investing. So delighted to be talking about that today. And really sort of taking a double click on the topic we'll be speaking to, which is seed to growth, the Canadian opportunity. Canada truly is emerging as a global innovation hub. As it relates to successful entrepreneurship, but particularly, I think, in technology, in life sciences, and given what we've heard, as I said, from Hong Kong investors and their closeness to Canada, the success stories in the market need to be shared. And as I said, delighted that we'll be speaking that today with two experts in the field, Ian Carew, my colleague at Northleaf Capital, and Corey Jeffrey from Innovia. So with that, why don't we give brief introductions, and Ian, start with you.
Sure. Good afternoon, everyone. My name is Ian Carew. As mentioned, I'm a managing director and venture partner at Northleaf. I've been active in the venture capital ecosystem going back to the late 90s, originally with Ontario Teachers Pension Plan. Subsequently, I was at CalPERS, which is the state pension plan of California, where I ran their global venture, get this a little bit closer to my face. Their global venture strategy. And then I came back to Canada in 2008 to launch and lead the venture capital strategy at Northleaf. Northleaf is we oversee about $31 billion on behalf of our investors, focused on three strategies: venture capital and private equity, private credit, and infrastructure. We are one of the most active investors in the Canadian market across two strategies. The first is a mid-market private equity strategy that we manage on behalf of CPPIB. We've been doing that since 2006, and we recently announced with them an incremental $750 million to continue investing in the Canadian mid-market, both funds and in companies. And we also manage a venture capital and growth equity fund of funds. These are programs supported by the various governments in Canada. Our first fund back in 2008 was supported by the Ontario government. 2014, 2018, 2023, we raised funds supported by the federal government under their Venture Capital Action Plan and Venture Capital Catalyst initiatives. And I think we can tell, maybe just as an aside, you can guess who's the early stage venture investor on stage here today.
I'm wearing a collar. It's pretty dressed up.
Sweltering.
Yeah, I'm pretty dressed up. Is that your intro? That's good. Yeah, my turn?
Yeah,
awesome.
Your turn. Yeah.
No, that's good. I mean, I learned a lot about Ian there, so that was good. Hi, everybody. I'm Corey. I'm a partner at Innovia Capital. Innovia Capital is a 20-year-old VC firm headquartered in Canada with a global footprint in Europe, the GCC, and other places. Yeah, so we've been around for a long time investing through mainly software cycles, right? So thinking about mobile, cloud, and now as AI eats the world of software. We're a full stack fund. What that means for us is that we have funds that do early stage, so think first checks into companies when they first incorporate, as well as a fund-to-fund strategy where we invest in early emerging managers to help anchor their first funds. And I think we'll talk about that more a little bit later. The flagship program is a venture program. We're on our fifth venture fund. So think about seed to Series A, check sizes around somewhere around $5 to $20 million of our money in that sort of range. And then we also have growth funds that do Series B to pre-IPO. So that we are a full stack venture fund. Prior to, I have not been in venture as long as Ian has, but you still look great. Yeah. But prior, so I've been at Innovia for about 4 years. I'm a partner on the early stage fund to fund and the venture side. And before that, I was at Google for about a decade, where I oversaw engineering operations in Canada, with another partner of ours, Steve Woods, and grew the engineering office there from about 200 to about 2,000 when I left. And lots of interesting stories there that have to do with AI investing and how we think about things, but maybe we'll get into that a bit later.
Great. Thank you, guys. So before I think we dive into specifically investing and covering off seed, early growth, and we'll finish with some comments on AI. I know that's of certain interest to many. We'll focus on the Canadian market. So Ian, just thinking about the audience and maybe a less of a familiarity with venture capital and sort of the broader entrepreneurship success as it relates to the Canadian opportunity, maybe you can just give some context, perspective on the overall scale of the Canadian venture capital market, what that looks like, why investors should really be paying attention.
Yeah, I'm happy to share a few stats, and I think in typical Canadian fashion, we probably undermarketed the opportunity in Canada. But if you think about Ontario, it's actually the 4th largest venture capital ecosystem in North America. So you think obviously Silicon Valley, Boston, Massachusetts, New York, and in any given year, Ontario would be 4th or 5th largest. So a really relevant venture ecosystem. British Columbia and Quebec are both in the top 20. So 3 important venture ecosystems in Canada. Another way to think about the market is Deloitte recently put out their North American Technology Fast 500, the fastest revenue growing companies in North America. 23% of those companies are actually in Canada. And that's a dramatic outperformance. If you think about the US venture market, somewhere around 60 times the scale of the Canadian market. So the fact that 23% of those companies really very significant contribution coming out of the Canadian market. A couple other interesting stats. Startup Genome put out a recent report. There's 3 cities globally where more than 50% of the venture dollars are being invested into the AI sector. That's Toronto, Beijing, and San Francisco. And then, one final stat is about half of the capital being invested in the Canadian ecosystem is coming from international investors. So the best venture funds, best venture investors globally have latched on to the opportunity in the Canadian market and are actively investing.
Great. Corey, maybe it'd be important, I think, for you to talk about the key drivers of a healthy VC and growth ecosystem and maybe line those up against what Canada is doing broadly for that.
Sure. Yeah. Yeah. So I kind of think about it three things that you need in a VC ecosystem. You need talent. You need capital, which Ian talked a lot about, so maybe I'll skip that one. And you need the ability to exit and realize that capital to have a flywheel effect that goes back in. So let's take them in order. On the talent side, so Canada punches above its weight on sort of 2 dimensions as it's relevant for what I do. One is of the top 25 schools in the world that create founders. So if you took every single venture-backed company in the world, 3 of those schools, of the top schools, are in Canada. That's University of Waterloo, University of Toronto, and McGill, right? So lots and lots of young talent coming out of universities are trained in Canada. So there's a culture of innovation, right? On the other side, and this is a little more putting my old Google hat on, is engineering talent. And I know that the computer science and engineering deans were here for an event in Hong Kong on Saturday. In Canada is world leading, right? So when I was at Google, we opened offices beside, for example, the University of Waterloo, very specifically to get engineering talent. That is what we did. We used to joke that if Google had to pick between the people in the Google office and the people at the university, they'd keep the university people because that would be the future, right? So if you go and spend time in Silicon Valley, you will find Canadian graduates of computer science all over the place, right? And they are at the top startups, both in Canada and abroad. So talent-wise, you need that at a basis. On the capital side, actually, I thought Ian did a really good job on that, so maybe I'll skip that a little bit. But I think last year in Canada it was like $6 billion invested in capital in the country, which is, when you look at the trend of growth over time, it's like growing quite quickly as a destination. So good to have capital. Then on the exit side, you would have if somebody was to be, Todd, you asked how people line up, like how this lines up globally. The knock on Canada historically has always been that great talent, great ideas, great innovation, exits too early, right? And so as part of one of the reasons that Inovia started was to have patient local capital at multi-stages to enable people not to have to sell to a multinational in the US. I used to be the multinational buying the Canadian companies, right? So, sorry. Today, what you see is a huge uptick in the number of unicorns in Canada, right? So I'll botch the stat, but it's something like since 2019, there's over 20 unicorns who have been minted in Canada. And when you look at a bunch of these companies, think about, Wealthsimple, Hopper, Clio, Cohere, a lot of these companies are coming really close to decacorn status. And so why that's important is it's indicative of what does that next fundraising look like for them? It looks like a potential IPO. It looks like a potential major acquisition, not like a $50 or $200 million acquisition. And that money comes back into the ecosystem. And this is the flywheel that you want to have, that you see in the Valley, that you see in places like Sweden. These are the things that are exciting. So yeah, that's how I think about the ecosystem.
Okay, so let's double click now and get into seed stage investing. And Ian, thinking about the strategies you oversee, the seed stage as it relates to Northleaf, you've, I know, increased that exposure over time. And what are sort of the drivers of doing a double click and emphasizing that more?
Yeah, so I think back to our 2008 fund, we were probably 5% seed exposure. Turning to our 2023 fund, it'll probably be 30 to 35%. So I think there's a couple of factors driving that. Part of it is the maturity and evolution of the Canadian ecosystem. There are just more attractive managers to back today. I think we think of seed as a local business. You want to be close to the entrepreneurs. You want to be able to source those really exciting opportunities. And then you want to be around them as they need support, as they build these really early companies. So we think that's a really protected market, really protects the local investors from those international competitors. And then really it comes down to returns. We have seen the best performance across stages coming out of the seed stage. So we've really leaned into that market as part of our investment strategy, given that return profile. And I think it's similar. Corey had the similar experience at Inovia.
Yeah, and Corey, just thinking about your fund at Inovia called the Discovery Fund, that launched in 2022. Maybe talk about the strategy, what that is specific to seed and the experience so far.
Yeah, so Discovery for us is company formation. It's fund to fund. So a couple things. Inovia has formalized the Discovery strategy in 2022, but actually we were doing side of our desk sort of fund to fund investing in Discovery since 2015. And so, when you've been in an entrepreneurship ecosystem for a long time, you start to have a deep network of really excellent founders who then do their next thing and then do their next thing. And so you want to support those people. What we learned doing sort of off the desk, hey, this isn't core mission to like a Series A fund to do a company formation, or not a core mission to do like a Garage Ventures first fund. What you learn is that two things. One, the returns are excellent because the median IRR of a fund under $50 million is like 24%, right? The median IRR of a fund over $100 million is 10%. Now that's a median, you want better funds, that's where you're trying to put your money in, but there's a bunch of alpha there. And at the same time, if you were to look at where the LP money is flowing today, as the world gets more unsure or more, less, I guess maybe less stable would be the euphemism to say, LP money starts to go into more blue chip things, right? So they look for funds who have been around a long time, funds that have returned capital so that they're comfortable with the preservation of capital. Well, that's not emerging managers. By definition, emerging managers are fund 1, fund 2, fund 3. So what we do is we come in and we help be the first institutional money in a lot of these checks to enable these individuals to see if they can build, preserving institutions of funds within Canada. We do it in Europe as well, a little bit in the US. And so that's sort of that ecosystem play. The other thing it does is it gives us asymmetrical access, right? Like Ian was talking about, you need people who are right at the edge of when an entrepreneur is about to make a decision, right? That's when you start to understand whether or not you know this is something that you want to invest in. And emerging managers and small funds live on university campuses, live in deep labs. They live right at the edge of the decision of what's about to happen for people making that first really risky idea before there's anything to underwrite. And so if you have a network of those people that you can have relationships and leverage those relationships to then understand when it gets to your stage, whether it's the right thing for you to pay attention to, that's really, really powerful. To date, we've done, in the Discovery Fund 1, which was our first formal fund that did this, I think it's 25 funds total. Of that underlying portfolio, there's about 1,000 companies under there. There's 45 unicorns in that group, of which Inovia is now part of, I think, 7 or 8 of them, right? So picking these things. So this is asymmetrical information in venture is powerful.
And I maybe just add to that, I think to your point of concentration, I think last year or the year before in the US, the top 6 brands represented over 50% of the capital raised. So the market's really bifurcating into that's a barbell, right? You've got the large allocators. It's easy for the institutions to write big checks into those funds. And then on the other side, you've got these really interesting small funds. They're 25, 50, sub $100 million. And again, the large funds can't participate in that, but that's where the alpha is being generated.
So how is that sort of dovetailed with, changing Northleaf strategy over time as it relates to seed?
Yeah, I think as I mentioned, we've really leaned into that sector as it's matured. We are generating really outsized returns relative to other stages. The other, I think, trend that we've noticed and supported over the last couple of years is the emergence of pre-seed relative to seed. So pre-seed, these are small funds, typically solo GPs, and they are targeting, really they're just backing entrepreneurs with a great idea. There's not a lot of traction, there's not a lot of proof points, and we really noticed this trend where groups like Inovia, some of other seed managers in our portfolio, were making these commitments to smaller funds to really identify these really emerging companies and develop those early relationships.
And so, Corey, I guess it's the discovery process is really sort of fueled by the breadth and depth of what you're seeing there in terms of how that translates to early stage and growth on the other side of the platform.
Yes.
Yeah, but
it's a simple investment process, right?
Yeah. But
don't make it sound easy; they'll kick you off the stage.
But I was going to say, the number of deals in your early stage fund that come out of that discovery, it's a pretty high percentage.
Yeah, I mean, the whole thing is set up so that, like I said, you need asymmetrical information to understand whether or not you want to do something. You have to have expertise in the area that you want to invest in. So we're a thesis-driven investor. We have several areas. So if I say, here's the team on cybersecurity, I have 200 underlying cybersecurity in the emerging manager portfolio, then I have enough signal to say I should pay attention to this company. Paying attention to a company is part one, right? Knowing where you want to spend your time, winning the right to interact and then invest in that founder. The best founders are contested, right? VC is a game of being asked for money and saying no, and then asking others if they'll take your money and then having them tell you no. That's what VC is, right? So what's really important for this is that you get that information from the emerging managers, you have your own thesis areas that you dive into, and then you get to leverage the relationships so that you're not starting to zero, to be able to prove your value to the best founders so that they have a reason to take your money. And that's sort of the trick.
So maybe switching gears, obviously the last 2 weeks, Canada-US comparisons have been many. I know that's been the talk of our trip and getting insight there. Let's take that to early stage investing, and maybe, Ian, you can contrast the Canadian opportunity as it relates to the one in the US and the growing attractiveness of Canada.
Yeah, so I think definitely the scale was one comment I made, where the US market is obviously dramatically bigger than the Canadian market. I think another interesting feature of the Canadian market is outside of a few sectors, maybe fintech, no Canadian companies are really being built to, you can't grow servicing only the domestic market. You need to have an international focus. I think historically that's obviously been the US, but increasingly broadening to the rest of the world. you know, there's a few other interesting factors around the Canadian market. The funds tend to be smaller. There's less availability of capital to support those funds. And I think that forces a certain discipline on the companies. They need to be more efficient given they have less capital than their US peers. And there's a number of really supportive Canadian government programs. The SHRED program, the Scientific Research and Experimental Development Program, which provides refundable tax credits to these companies, which really helps you stretch your equity dollars. And you take and then the Canadian companies, maybe Corey, you might argue, but like in many cases, the Canadian companies are at lower valuations relative to their US peers. So if you take a combination of lower entry valuations, more efficient growth, you don't need those outsized returns to generate a really attractive return profile for your investors.
So Corey, you know, just thinking about your platform and what it's like competing against US VCs on the early stage side, and what are you looking for in the companies you're approaching, but also, you know, how do you think about that in terms of, you know, competing against the US?
Yeah. I mean, this kind of goes back to the thing that Ian said about whether or not I would argue with him on something. I am going to argue with Ian. The valuation for Canadian companies on average is lower. The valuation for the best Canadian companies is at par with the US. Why? Because I'm not competing with another Canadian VC. Capital is global. Toronto is an hour flight from New York. I walk around Waterloo where I live, and I run into people from A16Z and Coastla and all of these other places, right? Like this isn't a closed border ecosystem through which capital doesn't flow. So you asked a question about how to compete. Okay, so a couple things. One is the approach for Inovia and for Canadian VCs in general is not exclusionary, right? You want foreign capital on the cap table. You want American VCs involved as well. What you don't want is everything to be funded by non-Canadian VC. So what we do is we take a collaborative approach. And so we have a lot of co-investments with a lot of the top firms around the world because you need to create the best ecosystem within a company for that company to be able to succeed. Like think about the board dynamics, right? Think about what you add to a company and then think about what else somebody else around the world getting involved in that company can add. And does that make that company have a better chance of being a global leader? That's what you have to do to think about whether or not you're going to have returns because like, look, 80% of your returns are going to come from 10% of your investments. The majority of venture returns in the world are going to come from a small set of winners and you're either in them or you're not, right? That said, it's not all roses. We compete on everything. All VCs are sort of frenemies, right? Like we do compete for the same things. So there's a couple ways to do it, in my opinion. I mean, there's a million ways to do it, and every fund has to have their own way to do it. The way that I spend time doing this in particular is we talked about the asymmetrical information, which helps us understand where we want to spend time. The other thing is, like, say you've then got yourself the right to be in the room with a founder. Now you have to win how they think about the value that you bring. So if you put yourself in the shoes of a founder, you've talked to 40 VCs. You know, in some cases you're pitching them and they're saying, ah. In other cases it's the bit flips and they're pitching you because you have a hot deal. There's a lot of monotony in those interactions, right? VCs ask similar questions. What is your market size? What is this? What is that? Blah, 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 right? Like these are not magical questions. There's no magical answer to what you're looking for, but it's consistent. So if you want to break out of that monotony, you have to have something different. So for myself in particular and the team that I work with, it's about being technical. In a world where AI is eating software, where a lot of very technical founders are leading companies, if you can sit down across from someone and be like, hey, how did you build your product? Oh, did you think about this? Oh, how did you make that technical trade-off? And now you're into a very different, deep conversation in a world where they've decided to spend their life on this problem space, which is a very irrational thing to do because statistically they are going to fail, right? So they care very deeply about the thing that they've decided to spend their life on. And so when you care about that thing and not just the finance and the business behind that thing, then you can stand out. And then you're projecting to them like, this is what a strategic board conversation could look like. It's not just getting up and doing the numbers to people who only care about the numbers. Now you're building a relationship. Now you start adding value. then you win your way into the deal. That's how you get your way in. In my case, that's how I focus on it. And that's how you differentiate against other players in the marketplace. But that's just an example of differentiation of how I think about it.
Yeah, and I think, it's interesting sort of the topics we've covered, seed, early, and we'll move into growth. Just thinking about accessibility to each of those has its own nuances. Some would argue, as Corey just did, that getting into the early stage opportunities is especially difficult, but we've also found that with our investors and the conversations we have, it is the growth stage investments where they have a more difficult time readily accessing. So, Ian, maybe talk about the strategy that you oversee and just, why that's particularly compelling from an access standpoint.
Yeah, so for us, we're a co-investor into growth stage opportunities. We're typically looking for companies that are 10 million revenue and greater. We use that as a proxy for product market fit. We don't want to take technology risk, we want execution risk. And so we have, similar to Corey talking about the Discovery Fund, having a bunch of relationships, hundreds or thousands of companies. You kind of monitor those to see the breakout companies, and then you leverage your relationships to get access. So again, we're investors in Novia's funds. We've probably done 5 or 6 co-investments into their breakout portfolio companies. And again, we think of our portfolio a little bit as a greatest hits album. There'll be 15 artists, 22 songs. Again, if we're doing our job right, we've picked the best couple of companies across everyone's portfolio.
I like that, greatest hits.
You can borrow that.
I'm going to use that.
I've been working on it.
Yeah, it's
a
good.
trademark. Yeah.
To sing us a bar.
And Corey, I know your growth stage focus is especially focused on Canada. So, why is that, and what is different, say, versus the other markets?
Yeah, so going back to the comment I made before about the knock on Canadian firms historically was that they exited too soon, right? So take that sort of $200 million exit, or hard to look a founder in the eye and be like, don't make $40 million, right? Whatever you do. But part of that too is like you can run into this situation of especially at the growth stage, capital gets tired, right? Funds go in cycles. Perhaps you have people on your cap table that need to exit. So you need patient capital at all stages to care about creating local winners, like scaled local winners. So in 2018, Inovia sort of looked around the ecosystem. Growth investing was sparse. And so set up a growth arm to the firm, went out and grabbed 2 people. So aside from Chris Arsenault, who is one of the founders of Inovia and does a bunch of growth investing, we wanted to do this in a way that not only provided capital, but also provided very specific expertise, right? Because one part of needing to scale a business is having the money and the patient support to do it. Another part of it is like having the people who know how to operate at that scale, right? That's a different thing. Starting at 0 to 1, 1 to 100 is a very different skill set. So we had 2 people join. We had Patrick Bichette, who was the CFO at Google from 2007 and 2015. And one of the reasons I joined Inovia, I worked with Patrick at Google. And there he oversaw, like if it wasn't technology and it wasn't sales, everything else was Patrick's, right, for the entire company. So he's the one who bought DeepMind, and he's the one who bought YouTube, and all of that sort of growth. That's a person that now sits on the board of, say, a Wealthsimple, as they think about how they grow that company. He sits on the board of Cohere. That's a hell of an asset to have in Canada with Canadian capital that didn't really exist before. Another individual was Dennis Calverman, who was employee number 20 or so at BlackBerry, was the CFO of the publicly traded company, and saw that story go from 0 to whatever the market cap was, however many billions that was. Again, somebody in their corner who has patient capital, who will take it from growth stage to IPO and actually has IPO'd something and knows what that looks like. So that was the approach we took, and we are starting to see it pay dividends. I mentioned some examples, like a lot of the companies that I had mentioned just before are now entering that decacorn phase, and that's the sort of path that our partners are on with them to help them create that circle of payback that then goes back into the ecosystem to have more in the future.
Corey, maybe also comment on what's on everyone's minds, certainly more recently, but really over the last 2 years, and that's liquidity. So, we are noticing M&A is starting to change here more readily over the last few quarters. IPOs are sort of peaking out again. Feels like things are starting to change.
Yeah. Although, what I have learned, I've been in Hong Kong since Saturday, and I've been talking to lots of people, which has been a lot of fun. And I have heard that the Hong Kong public markets are now open again, and that there's all sorts of IPOs happening with Minimax and others. Is that true? Yeah, very exciting. Yeah, I mean, in the North American side, there's a couple things. Like, the way I think about this is there are those who are AI, whatever that means, right? And there are those who are not. And here I'm going to like bucket this in the software space, right? Because that's my world. And those who are in AI, I'm trying not to swear, sorry. It's bonkers, right? It's absolutely bonkers. And by that I mean, like, the valuations are crazy, the acquisitions are fast, right? Like, I'll give you an example. There are machine learning research experts, like world-leading ones, who have agents, like sports agents, that negotiate their compensation. I shit you not, that's a real thing, right? I try so hard.
I won the bet.
Yeah, you did win the bet. I try not to swear, sorry. I know it's very professional. So in that world, why do I mention this in the world of acquisitions? Is because there's a lot of talent acquisitions as people like OpenAI and Google and Meta are using their, well, for Meta and Google, they're using their balance sheets to try to create, take a limited asset and suck it up, right? So in that world, there's weird risks that didn't happen before. Like, you've seen these companies that get bought, like, the company doesn't get bought, the founder gets bought out of the company, and the company still exists, right? That wasn't a thing before. Like, that wasn't really a thing. But that is something, because if you go up to somebody and you say, hey man, isn't it really hard doing a startup? Did you know that your expected value per year is about $40 million if you come work for me? Yeah, maybe you shouldn't be working on that hard startup anymore. So that's in the M&A space in AI, and that's a very risk, and it's a really hard risk for investors to oversee. On the flip side, when you can line the company up with the strategy of the big acquirers, the multiples are bonkers, right? So like Wiz, do you guys see the Wiz acquisition? That was like, what is it, $32 billion, right? So that's that side. It's very, very high. On the other side, right, of the non-AI bucket, what you have is sort of a going back to fundamentals in a way that AI has not yet had to do. So for public markets, the general idea is, hey, it might be opening up again. People are getting ready for IPOs. You better have, if you're not an AI company, $200 to $300 million of revenue and be a sort of rule of 40 company, right? Like, that's the sort of window of people who are getting ready. And on the other side, you might see, I mean, this is not a IPO prediction. I have no, caveat, okay? You might see companies like OpenAI or Anthropic do an IPO because of the eye-watering burn and how long can private capital actually sustain that, right? And so then you IPO to be able to fundraise on that. That's a really different profile of somebody with a rule of 40 company, right? So what do I think is going to happen? I think we're going to see that play out. And yeah, that's what I think.
Okay. We'll get to AI a bit more in a second, but let's talk about the other massive theme that's been hugely prevalent over the last couple of years in the private markets, and that's secondaries. Ian, maybe spend a few minutes just on, as it relates to the growth stage in particular, what secondaries have mean and why more have been gravitating towards that.
Yeah, so I think one big factor is, and Corey mentioned companies getting to decacorn status. You don't get there unless you have a longer runway. So I think one significant trend is companies are staying private longer, more of the value is accruing to the private investors than the public investors. A second component of secondary, I mean, who doesn't like getting something at a discount, right? It was typically secondaries happen at a discount to the current value, really attractive entry point for investors. And Corey also mentioned, it's hard to say to a founder, don't make $40 million or take $40 million off the table. But what you can say is, why don't you take 10 off the table, sort of have some financial stability, and then put yourself in a position to take that company further. What we've seen is and I guess the final piece of that is, well, while the public markets and M&A volumes are picking up, since the market peaked in 2021, those have been really soft. So the traditional exit markets have been hard to access, and really secondary has stepped into that gap to provide the liquidity. And if you look at 2025 exit, it's about a third secondary, a third IPO, a third M&A. So I think secondaries are here to stay. There's always a need. Someone always has a need to sell something for some reason. And again, you shorten the duration by coming in late. You can get a little bit of margin of safety by buying something at a discount. And so again, we think that's a really attractive segment. I'd say it hasn't played out as much in Canada yet. I mean, this has been a global phenomenon for sure. We've definitely seen direct secondary where a new investor buys someone off the cap table, and that's been fairly active in Canada. But if you think about continuation vehicles, which whether it's single company or multi-company continuation vehicles, that's still quite nascent in Canada. And I'd say there's limited fund secondaries to date. Again, the funds tend to be smaller. There's a lot of legwork and underwriting to go into those. But I think those markets will continue to grow as the Canadian ecosystem matures over time.
We've got about 10 minutes left, and I do want to leave time for questions, but I want to make sure we spend the last topic and devote that to AI, as I said. So, Corey, just thinking about the building blocks, what has been done in Canada, what is going to continue to happen in Canada as it relates to AI. Maybe talk about some of those entrenchments that have been built in the market that have been really fueling much of the activity and early success in AI.
Never heard of it. Just kidding. Okay. Let me think. So at the base level, the way that AI is done today, so machine learning, right? If you're machine learning, neural nets, a lot of that work, the foundational work and the invention of that type of AI is from Canada. So you might have heard the name Geoff Hinton. He's known as the godfather of artificial intelligence. He's at University of Toronto. He won the Nobel Prize in the Turing Award. Turing Award's like a Nobel Prize for computer science. Jeff's at the University of Toronto. He's been there since the 80s, and this is his life's work that is driving, when you use ChatGPT, when you use Gemini, when you use Cohere, whatever you're using, like a transformer-based model, this is what this is, right? Another individual, Yoshua Bengio, right? So Yoshua is in Montreal. He invented deep neural nets. Yoshua is another Turing Award winner. Okay, third guy, Rich Sutton. Rich Sutton is in Edmonton, which is in Alberta. Rich is known as the godfather of reinforcement learning. So when you think about models that get better by learning through a specific task towards an outcome, that's reinforcement learning, and Rich is the person who is the foremost person in the world on that. All three of those people have been working in Canada in the academic world since the 80s, right? So that's a pretty good building block. Why? Because Canada is a massive importer of talent in the machine learning world. People come from all over the world to work with those individuals, to work in their labs, right? And to be educated in Canada. If you step back and look at the chief scientific officers or the leadership on the actual technical side of almost every major North American lab company, they are Canadian or they are educated in Canada because they came out of those labs, right? As a building block, that's a pretty good start. So that's one piece. The second piece, I guess, is, sorry, what's the question again?
I think you're good there.
Am I good?
Yeah,
all right.
You're good.
I'll stop.
You're good.
I'll stop. Todd, I'm verbose if you ask me about AI.
Ian, maybe a last question, and then I want to ask a sort of capstone, all-important question. But maybe just talk about how sovereignty is important as it relates to AI. It is a crucial element, and specifically how the government in Canada has supported that.
Yeah, I think obviously sovereignty is not just a Canadian issue, it's a global issue. All countries are trying to figure out how they you think of it as infrastructure, right? Like you need roads, you need rail, you need ports, you need energy or utilities, and AI and data centers is no different. You want to, for national security reasons, for having economic benefit into your country, for having it subject to your regulatory framework. It's important to have that infrastructure in your country. And I think the Canadian government has recognized that. They've launched a number of programs that support research, that support talent training. They've made a big push into providing access to high performance computing. So I think that's been a really important component of helping support the Canadian ecosystem. I think the other piece that Corey mentioned previously is you want to have domestic capital invest into the ecosystem and to close that flywheel. So when you have exits, that capital gets redeployed back into the ecosystem, and you kind of have this virtuous cycle. And the federal government programs that we manage are a big part of that, where in the 2025 budget, the federal government committed another $1 billion to this fund-to-fund initiative, again, to help get more capital into the Canadian ecosystem to continue to drive continued innovation.
Okay, maybe in the last minute we have, and I do want to take a couple questions, going to ask each of you, are we in an investment bubble within AI? Because we know everyone is asking, so.
Yeah, Ian.
I was going to say Corey. As the AI expert, I think Corey should.
Oh, Christ, yeah. Man. Look, I mean...
1 minute, Corey.
1 minute. All right. The selfish answer is no, of course not. Look, okay. Two things can be true. People often wildly overestimate in the short-term horizon the impact of a technology, and then wildly underestimate it in the long term. We saw it with the internet, right? Webvan went to zero, pet.com went to zero, everybody traded down to absolutely nothing. People decried that the internet was dead, and then 20 years later, that happens not to be the case. I think that there is a lot of excitement in the ecosystem. I have looked at companies that raised $2 billion on the back of a napkin at a $12 billion post-money valuation with zero product, and is currently raising $10 billion today at a $50 billion valuation, still no product. That's a really far future-looking bet into the value that company can provide, right? For that to make any sense. So do I think that there's a lot of excitement in the space? Yes, I do. Do I think that at some point that excitement will have the air let out and that companies with actual fundamentals and businesses will be in a better state than those that do not? Yes. Yes, I do.
Great. Thank you. So we've got a little bit of time left for a couple questions. Love to have a few. Yeah.
Okay, you get the mic next. It's okay. Dave Armitage, been here for 30 years, IT services. Todd, Ian, good to see you back. Mantra to Canadians is come back. We're friendly. We like you. Come and enjoy us. Ian, or Corey, I think this is maybe your first trip with Innovia. So good to see you here. Why are you here, and are you successful? What, are you looking for entrepreneurs? Are you looking for funds, or what you doing here?
Yeah, I mean, we're figuring it out. I'm here because Ian invited me, and because it would seem like a great opportunity. One of the ways that we think about other markets is, we start showing up, we start understanding what the investment landscape looks like, and then we start partnering with locals. So I've talked a lot to local VCs. Having someone like me show up who knows nothing about the local ecosystem and stomp around and throw money around is not successful for anyone. So we're in the very early innings of what that success would look like. Yeah.
But I think it's also to the point of historically Canadians always look south. We look to, develop relationships in the US, and it's a big, beautiful world out there. And we need to develop those relationships and insights such that, we can have a more robust global perspective.
Thanks. Yeah, can you talk a little bit about the tax environment in Canada? I mean, in Hong Kong, we're a very low tax jurisdiction, as you've probably heard, and people get a little bit scared about high tax environments and what it means. Can you sort of tell us a little bit about the tax environment in Canada relative to US or Europe or other places, and what that means for your kind of investing? Thanks.
Why don't we give that one to Todd?
They're higher. No, I think it really goes back to everything these guys were talking about in terms of government support and what that ultimately means for thriving companies. So yes, we are in a higher tax regime specifically within Canada, but you know, at the end of the day, if that government support isn't there to get those companies off the ground in the first place, and there are specific different apparatuses, different regimes in place to help fuel that growth, it doesn't matter anyways. So yes, you can make the commentary that, you know, there is a higher tax you know, regime in Canada compared to the US, but I think we want to get those companies off the ground and thriving to enough of a place where, you know, they can succeed and they can compete against you know, bigger companies in the US.
And I can say when I moved to California, my tax bill did not really go down. And you add in healthcare on top of that, and
And that's a good point, right? We spoke about the sort of local markets in North America and how a market like Toronto compares to a New York or in California, and the taxes aren't significantly different. So.
But it is a big issue when you talk about talent acquisition or keeping talent, attracting talent, keeping talent, and so that is obviously an important conversation with the government around what programs you have, how do you moderate that. Capital gains tax was a big issue. So it's a kind of an ongoing and important conversation to make sure that we can remain globally competitive particularly for talent.
Yeah, capital gains exemptions, when used well, work out well for founders. The other side of it is that SR&ED is a R&D tax redemption for companies. So they get about every dollar, I'm going to screw this up, and the government people in here will have a better view. But every dollar you spend on R&D, you can get about 50% of that back. So for the company itself on the bottom line, it depends on how you spend your money, but there is some balancing factors, but yeah, it's higher.
And it has to be Canadian controlled, which again, Canadian controlled private company. So that does create an opportunity for Canadian investors to be part of the cap table to ensure you get that. That was like 35% refundable tax credit. So another rationale or support for having Canadian investors on the cap table.
Okay, maybe one more question.
Okay, question for Ian. I know that Northleaf, your venture capital more focused for life science, that kind of things. Is any difference? Are you more focused for the Canadian own this kind of life science or the, okay,
Yes,
also go ahead.
Yeah, so we did, I mean, we mainly talked about technology given Innovia's focus and probably about 70% of what we do is technology focused investments, a broad set of technologies. Actually about 20% of our investments are in the life science sector, and then the remaining 10% would be climate and sustainability. And you know, while the life science market is relatively smaller in Canada, it actually punches well above its weight. So a number of the largest exits in Canada have been in the life sciences sector. So it is an important sector. It probably doesn't get as much capital as it needs to develop the local ecosystem, but certainly an important component of the Canadian ecosystem.
Well, gentlemen, thank you very much. This was a great panel. Hope everyone enjoyed it, and thank you.